The 2-year and 10-year Treasury note yields have inverted, so we must sell everything and go into cash, right? Hey, this is Matt from Let's Not Be Fools, the channel that brings you financial and other advice a couple times a week. Hit the subscribe button so you don't miss a thing. Now let's talk about the 210 yield curve inversion. A little while back I posted a video on yield curve inversion. I'll put a link down below so you can check that out just so you can get up to speed on what it is. But we're going to go into a little more depth of what the latest developments are. The yield curve has been inverted for a while, but last week was the first time that the 2-year note and the 10-year note yields inverted. And that's a more significant event, although let's take a deeper dive into that and see what it really means. Last week, the financial markets went into a tizzy because the 2-year Treasury note and the 10-year Treasury note yields inverted, and usually that's a pretty good indicator of a forthcoming recession. When we last looked at the yield curve together back on May 30th, this is what it looked like. It was definitely inverted, although the 2-year and 10-year notes were not inverted at that time. Flash forward to August 1st of this year, you'll see that it is still inverted, although the 2-year and 10-year note still is not inverted. But last week in mid-August, the 2-year note and 10-year note yields inverted briefly, and that sent a lot of people into a panic. There was a lot of sell-off in the market. Obviously, the Dow Jones dropped about 800 points that day. Here's the U.S. Treasury yield curve as of August 15th. The two data points that everybody is focusing on is the 2-year note yield and the 10-year note yield. As of August 15th, you'll see that the 2-year note and the 10-year notes are not inverted, although they're very close. The yield on the 2-year note is 1.48% and the yield on the 10-year note is 1.52%, very close to inverting. So although it's important to know that they did invert briefly, there needs to be a longer-term permanent inversion, let's say 1 or 2 months, before that becomes a negative indicator of how the future economy is going to fare. I just wanted to bring up some data that we found from Credit Suisse going back to 1978. The last 5 210 inversions have eventually led to recessions. A recession occurs on average 22 months following a 210 inversion. So think about that. It's not an immediate thing. The recession is still probably some time off if it comes at all. The S&P 500 index is up on average 12% 1 year after a 210 inversion. That's very interesting. It's not until about 18 months after an inversion when the stock market usually turns and posts negative returns. So again, this is not an immediate thing. There is some time to consider here, and on average it's about 18 months. So a year and a half out is when we really need to worry, but I say don't even worry until we know that that inversion is more of a permanent state, that it sustains itself over a couple of months. That is, it's inverted for a couple of months, and then we should maybe start to worry about our cash positions and what stocks we are holding. And last but certainly not least, the historical yield curve data is based on the average of 4 to 5% federal rates. That's not the case that we have right now. We've had 10 years below 2%. So this is not to say that the warnings are not there or even relevant. It's just to say that the crossover or the inversion might not be the predictive indicator it used to be. So we're sort of in uncharted territory. We've had 10 years of artificially low rates, and we don't know what that really means. So what does this inversion of the yield curve really mean in a low rate environment? We've never had this before, so we're really not sure how things will turn out. So bottom line, is it time to sell everything? Absolutely not. I think right now we just hold on to our positions and wait. Maybe be a little more conservative. You don't have to rush into stocks with more new money. Just keep the money that you have. Maybe think of investing in a mutual fund or ETF that focuses on stocks that pay dividends. That way you can build up the dividends. If the market does take a downward turn, at least you're getting those dividends and reinvesting those dividends into those stock prices at the lower price. That's the way to make compounding work for you, especially in a recessional environment. So don't panic. We still have some time, I believe. Again, right, the recession, if it comes at all, probably won't come for several months or even a year to year and a half to 2 years out. And again, if it comes at all. At the end of this video, I'll leave my video on panic selling. Definitely watch that because panic selling never works out for anybody. So avoid that. We don't want to sell in a panic. We just want to be calm and cool and be reasonable when we look at the markets and the future. And that's all I have for you today. Have a great day.